Welcome to the Freedom First Retirement Podcast, where we strive to simplify your financial life and provide you freedom from taxes, risk, stress, and poor advice. And now, here are your hosts, Darrin McComas and Sean Peel.
Hey everyone, welcome to the Freedom First Retirement Podcast. I'm Darrin McComas. I'm here with Andy Amoroso, one of our newest advisors, and today's date is October 26, 2022. And again, thanks for joining us. We wanted to take this opportunity to introduce Andy. He's working with a lot of our clients, especially in the Seattle area. So Andy's been with us since early February, and we're just blessed to have him. He's been a huge addition to the team. And we just look forward to continuing to build our company right alongside with Andy. And, he's been a huge part of our success this year. So, Andy, tell everyone a little bit about yourself.
Yeah, definitely. Thanks for introducing me, Darrin. Well, yeah, it's been super exciting coming on board here at Abraham & Co. And I'm super happy and blessed to be a part of this team. We have a lot of knowledgeable people that are working alongside one another, and just feel super blessed to have all the support that we have here. But I'm really excited. We've had a lot of success this year. We've been able to help a lot of new clients who've come on board, and that's really what I'm passionate about. I just love helping people. I love people. I love numbers. So it's kind of my background. Went to Western Washington University up in Bellingham, got my finance and management degree there, and spent a lot of time in the financial healthcare consulting world. I also have a background in insurance and mortgages as well. So, I'm super happy to be coming on board with a team who really cares about, not just, we always say that, not just about the numbers, not just about the zeros, but, really helping people through their journey in retirement. So, I'm happy to be here.
Well, we're happy to have Andy as part of our team, and you do a phenomenal job building that relationship, and it comes through because you really do care about people. You're passionate about helping them in retirement, and it's been a great year. Our company's really grown, but we're excited for next year, and what makes me excited heading in, can't believe we're talking about 2023 already, but it's right around the corner, and I'm just excited how we've performed this year, how we've really helped people preserve, their life savings. And it's been a tough year, but I'm really looking forward to hopefully next year getting through this market volatility. But I know you recently went to Italy, right? Yep. On a little vacation, and
we did.
Tell us a little bit about that experience and kind of compare and contrast Italy to the U.S.
It was good. It was a well needed vacation, that's for sure. We haven't been out of the country. Carmela and I, we haven't been out of the country since before the pandemic started. So we were just excited to get out and travel, get away from work for a couple of days. But boy, it was an experience. I've had the opportunity to travel around the world, and I like to go to a lot of the third world countries, countries that have a lot of history, and it's really about the educational experience. But this one was more of it was a fun luxury vacation, but we got a lot of history behind us as well. But
good food, right?
And good food, but I'll tell you, it doesn't matter where you go. If you're in the States, if you're in Italy, or if you're in the Philippines or China, everybody's dealing with the same problems, right? High inflation. What are we going to do about our costs? Yep. And everybody's being affected by it. We ran into so many people who live there, who were being affected, but they're navigating through the same things that we're navigating through, and our clients are navigating through, but yeah, it was just great to experience just another part of the world, see what people are doing. And I'll tell you, there's a lot of technology and a lot of infrastructure that is different as you travel around to different countries, and it's just amazing to see.
That's on my bucket list. I have not gone overseas, but definitely want to hit Italy one of these days. So who knows? Maybe when the kids get a little older, a little easier to travel, across the country and across the globe. But that always reminds me. I think people. It doesn't matter, like you said, Italy, Philippines, China. Everyone kind of has one thing on their mind, and that's like a recession, right? Like a global recession. So we're going to dig into that a little bit in today's podcast, and For those that are joining us on YouTube, we have some visuals that we're going to show you here. And those are just listening online. We'll try to describe these things. But one of the things it's a new piece to our billing software is the ability to send out monthly invoices to our clients. So we've had a lot of questions from clients. This is the first month we've actually sent out an invoice. And I just want to say this is not a bill. This is more of a breakdown of how your management fee is calculated each month. And it comes from our billing software, which is a company called BillFin. But we'll put an image up here. You probably received an email, that says something, your financial advisor, Darrin McComas, or Andy Amoroso, or has sent you an invoice, and it's accessible here. And if you click here, it'll take you into a separate screen where you have to put in your zip code, which is your password, and then it will bring up the invoice that you can download. So we had a lot of clients, reach out and say, is this legitimate? Is this real? Or is this, someone trying to hack my computer, a phishing attack, right? It is legitimate. It is from us. We probably did this a little in reverse order. We probably should have, let our clients know that this was coming out and that beforehand. But here we are. We apologize for any panic or concern we caused. But you will start getting these invoices each and every month. And it's something by law that we have to do as a RIA firm, as fiduciary advisors. Our clients need to know how you're being, how your management fee is calculated each month. And, we're about full transparency here. We have nothing to hide. So if you have any issues getting into that invoice and downloading them, just let us know. We'll be glad to help you walk you through that. But we just wanted to give you a heads up. Those are from us. They are legitimate, and feel free to download those each and every month so you kind of know how you're calculated. I do believe at the end of the year, we'll send out a detailed statement that kind of breaks down each month for 2022. So that is something you can write off on your taxes as well as your management fees. So we'll gladly send that out. Probably won't come out until January of next year, but it will show you a breakdown, which is important, right? We always talk about you got to know what you own. You got to know what kind of fees you're paying for. So
yeah, just for your records. So
yeah. We don't have a lot of new topics as far as legislation or Social Security or Medicare. Not a lot of new updates since the last podcast, but kind of this one's going to be more focused on the markets and what's going on. We're seeing a lot of volatility. A lot of it has to do with this narrative, right, Andy? It's the Fed pivot. It's been the main theme of the entire 2022 year. Yeah. Seems like every time the markets go down, people are needing and begging that the Fed stop raising rates and do a 180 and start cutting. It's known as the Fed pivot. And every time the markets get choppy, this narrative, heats up, and you see it all over social media. And there's a lot of theories out there that the Fed will stop doing rate hikes and actually stop and start cutting rates. Now, if you look at the Wall Street analysts, they're saying that there's still plenty of more rate hikes this year. And this chart, for those that are watching on YouTube, it's we're looking at over 5 more rate hikes this year. So obviously the Fed and the Wall Street thinks there's more pain as far as inflation coming.
Yeah, and you look at inflation, and inflation is still running pretty hot, and it's not coming down with the previous rate hike. So what other tools are there in the toolbox to control it?
That's about it, yeah.
And so, you see another 5+ rate hikes anticipated, and you just, kind of wonder, just like everybody else, when is that going to, stop, or when are they going to pivot? And, right now, what are our analysts saying?
Analysts think they're not going to hit the pause button, and they're going to keep raising rates. Tomorrow's Thursday, and the new GDP number comes out. And if that is a strong number, reflecting a strong economy that's still moving along, still growing, that's going to be, even though that's good news, it's going to be horrible news for the market, I think, because that's just going to give the Fed, again, the 2 thumbs up to continue doing rate hikes, because they know they have to slow this down. They have to hit the brakes on this economy. And as long as the economy is resilient and staying strong, the Fed is going to have to keep raising rates until something slows down and possibly breaks. So, and I always say, I find this chart fascinating. People need that Fed pivot to rescue the stock market and rescue their portfolio. But be careful what you ask for, because the Fed pivot isn't always a positive thing. And you look at this chart here, and for those listening to us, this chart just shows some of the nastiest recessions we've had, going all the way back into the 60s. And even though the Fed pivots and starts cutting rates, that doesn't mean the bottom is in. In fact, it just means it could be the start of a real market sell-off. The global financial crisis, right? Everyone remembers 2007 to 2009. The Fed actually pivoted, and we'll put this chart up, in August of 2007. And at that point, the market was pretty much sideways. But then the Fed pivoted, they started cutting rates, and then the bottom fell out. It took another 18 months before the market finally bottomed, and it was about a 50% drawdown from that point. So, a Fed pivot might spark a little, 2-week, 3-week rally in our markets, but then I think it's just confirmation that we are headed to a recession if they do cut.
And we just keep seeing, new lows, right, Darrin? We're just seeing fresh new lows. We get a little bear bounce, and I always get asked that question. Hey, it looks like there's a bounce in the market. It's coming back, and with all the information at our disposal, and the data that we are seeing, it just doesn't look like that right now.
No, I think the analysts that we use, Hedgeye Risk Management, I think they're some of the best in the game. They keep saying this whole narrative about the Fed pivot is complete BS. Fade it. We're gonna have bear market rallies. That is normal, right? That the market bounces. But you're right. It does make it bounces to a new lower high, and then it eventually makes a new lower low a few weeks later. So the rallies seem to be a lot shorter. We had a 6-week rally this summer. Now the rallies are down to literally 2 to 3 days in the market before the market plunges lower. And here we are. Here's a chart of the market performance year to date, and it's been rough. The NASDAQ, right, the tech stock index is down over 30%. The S&P still in crash territory, minus 20. Dow Jones doing a little bit better at just shy of minus 13%. But we think this is not over. We think there's more pain to come, and it really comes down to we're heading right into the teeth of earnings season, right? We had some big ones this week, and we'll get into those here in a second, but there's a lot of companies that have not reported, but so far, early in this earnings season, we're negative overall. And that goes right to what our analysts are saying, 4 straight quarters of quad 4. Quad 4 is that recession quadrant. There's just, they call it economic gravity. You just can't escape it. You can make up narratives, and you can have creative accounting as far as when these earnings come out from these different companies and try to make your numbers look better. But at the end of the day, you can't escape economic gravity. And 4 straight quarters of quad 4 and a deepening, going deeper and deeper into quad 4 each quarter, as this chart shows. This is why we think more pain is coming in the market. This is why we believe in having a risk management process, and we're not just winging it. Hedgeye is unbelievable at looking forward and not backwards. And we're going to stay conservative, and we're going to really try to minimize the damage if we can finish in the green. Right now, the way our portfolio is set up is we're pretty much kind of leaning a little bit to shorting the market in some regards. We're very big into the U.S. dollar. The U.S. dollar is usually one of the best things to own in quad 4. So there are particular days when the dollar goes down. Our portfolio maybe underperforms the market, but the general trajectory of the U.S. dollar has just been up and to the right, and it's been a phenomenal place to put your money. And we're just going to continue running very conservative until we get a better outlook from Hedgeye Risk Management. So anything to add on the outlook here? Wish we had better news, but
yeah, and the next slides we're going to kind of talk about, earnings are coming out, and a lot of earnings came out, today and yesterday, and you just start seeing, some of these growth companies, some of these technology companies, which really are an indicator of, what's going on in the economy, right? Because, a lot of these companies rely on disposable income, or they're relying on business-to-business relationships.
Right. Ad revenue, right?
Yeah, and so it really just tells a story of, where is the economy going, and, are people spending, more money? Are they going out buying the new next iPhone? Are companies going out and spending more money on ad revenue with Facebook, for example, and what are their earnings starting to show, right? And so we're going to kind of dive into that a little bit and just kind of see what's been happening. But things aren't looking good, and I really think this is the the tip of the iceberg.
Yeah, and again, these companies we're going to show you here are the big ones that make up really the bulk of the S&P 500. Microsoft's one of them. They reported yesterday, and it was not good. They went down 7.7% today. Wednesday, and probably will continue to sell off, but it's one of the worst days for Microsoft.
Yeah, they were already down 23%. Now they're running close to 31% negative on the year. So
and a lot of people own Microsoft either directly or through an ETF or mutual fund. And then Google, everyone knows Google. Google gets a lot of their revenues from advertising. So their ad spends were down significantly. They were down 9% today, and even more probably going into the after-hour trading session here. But like you said, these are kind of the canary in the coal mine, right? They really are looking forward as far as what the economy is doing, where it's going to go. And when a company is out there that use Google and like Facebook to advertise, like our company does, if you run into some tough times, and if it means laying off a bunch of people and doing a bunch of advertising, or do you cut your advertising, right, and keep the people and keep them employed? It's a tough position for these companies, and we're seeing kind of both. We're seeing companies starting to stop their ad spends or cut their advertising, and they're also either pausing hiring or they're starting to lay people off. And labor is always the last domino to fall. And when companies like Google and Microsoft and Amazon say we're going to pause hiring, or we're going to start trimming, and the non-essential staff we're going to let go, those are all warning signs that we either are in a recession or we're heading to one. Here's one. You love Meta. It used to be Facebook, right?
Yeah, I mean, I love looking at Meta just because they rely so much on ad spending, right? And we just talked about that. And if businesses are making those hard decisions and they're cutting back on their advertising spending, it's going to affect, these growth companies. And Meta's just a prime example, down about 60% on the year, right? And, we just, we're watching this after our workshop this afternoon, and they are down 6% today. You look at after hours trading, they're down, another 20%.
Yeah, 20%. When I took this picture, it was 13. Now it's 20. Just a few minutes later,
and so this is forward looking, right? It's telling a story of what's to come, for these big companies, and I think these are third quarter reports.
Yeah, they're looking backwards. Yeah.
So now we're going into fourth quarter. What is this going to do, next year, and how is that going to affect the market? And I think it just tells that story that, what the analysts are saying too, and the data we're seeing is, this probably isn't the bottom.
No.
And we still have a lot more to go in terms of what's the economy is doing and what's happening in order for us to figure out, kind of where that bottom's going to be. But, only time's going to tell. And
it sure is lining up with what our analysts are saying and what they've been warning for a long time. And that's why we use them. They're usually spot on about this. And, here's one that hits close to home, Boeing, right? A lot of our clients used to work for Boeing, and a lot of people own Boeing. But Boeing's had a rough year, down over 35%. Had a bad earnings report as well. And again, it just seems like the majority of the companies reporting today are missing earnings or having a whiff on forward guidance. So I wish we had, better news. I can't wait for that day sometime. It will be coming, but do we think the bottom's in? No. So, For those of you out there that watch the CNBC and all these guys on online saying the bottom's in, and I don't know how many times Jim Cramer's called the bottom is in this year on CNBC, but you really have to fade that crowd. And there's a lot of clickbait out there too. I get a lot of clients that will say, hey, should I buy this? Should I buy that? And, you got to be careful, when someone's pitching gold, do you really want to buy gold from a celebrity spokesperson? Obviously there's a conflict of interest there. And these guys on TV, they're pitching something. They get paid for, ad revenues paying for those shows. So they have to sound positive. And, there's really no consequences for them being wrong except for your hard-earned money. So we that's why we hire the experts out of Hedgeye, and we don't chase narratives and watch the news and these so-called experts on TV. So
well, I'm just so glad that as a firm we've gotten conservative, right?
Yes.
We've really saved our clients from significant drawdowns, and it just feels good. It feels good to be able to sleep at night. Really taking in the data and doing analysis using math and not emotion, to make these decisions. And, I'm just happy we're able to help people.
Because we see it a lot, right? We do a lot of events. We'll kind of get into our upcoming events here in a second. But, we meet with a lot of potential clients, and we do analysis on what they currently own and at other firms, and some are do-it-yourselfers, but the number one asset class, almost everyone, the biggest asset class is technology, and it's been one of the worst performing sectors. And we've been out of tech, pretty much the whole year. A lot of people heavy into bonds, one of the worst years for bonds. So, if you know of anyone out there that might be in that boat, another advisor, maybe they're a do-it-yourselfer and they're really confused about what's happening, we love referrals. It's one of our greatest compliments clients can give us is sending us a referral. So can't help everybody, but we have seen a lot of things this year from people that we've met with, and we're going to continue to fight that battle. We're going to fight for our clients, but we want to help a lot more people too. And we have some great upcoming events. Today we're at Verrazano's here in Federal Way, and you probably noticed the background's a little different than our office, and we're doing a couple seminars today, but we do have some upcoming events. On Tuesday, November 1st, we're at Chateau Ste. Michelle. Awesome winery. If you've never been there, it's unbelievable, but that starts at 6:30 p.m. And really these events are for people that have never attended an event before. So if you know a friend, a relative, a coworker that might need some help with retirement or is getting clobbered in their 401k or IRA, send them our way, have them come to one of our events, and they can experience us firsthand and in person, and we'd love to get to meet them. But you can email anyone that you think would be a good fit for us to my wife, who's our marketing director. It's Sammy@retirementplusnw.com, and she will make sure we get them on the list. Another cool event. We're back. We're going back into the colleges. For a long time during COVID, every college was closed to us. It's kind of how we started this whole thing, but we get to go back to Gonzaga. So for our local Spokane people, we'll be back at Gonzaga on Tuesday, November 15th. Again, that's an evening one. And then we'll be back over here on the west side, but in Snohomish.
Up in Snohomish, November 16th. So we have a lot of events, and we often sometimes do these afternoon events like we did today at Verrazano's, and we're doing that over in Snohomish as well. So if you can't make the 6:30 event, we have a 12 p.m. event as well.
Yeah, so, and that one's at the Trails and Tap House. We've never been there, but it looks like a really cool place. And we're excited to keep presenting. Every time we do a seminar, we meet awesome people, and we just listen to people and have conversations, and people are really scared. People are really worried about where this country is heading and what can they do about it. And there's a lot of bad advice going on out there, or just, I think a lot of lazy advisors too, that their only comeback to their clients is just write it out, just write it out. And that is definitely not us. So again, if you know of anyone, please reach out to us, and we'd be glad to touch base with them and hopefully invite them to one of our upcoming events. But we're getting to the end of today's episode. I'm glad we had a chance to introduce you to our awesome clients. And
good to be here, and good to be servicing so many of our new clients this year on the west side. So look forward to continue working with everyone, and thanks again for introducing me, Darrin.
Yeah, you bet. And as we head into the end of the year here, we're still doing Roth conversions. So many more meetings with a lot of you out there. But we got to take advantage of this time. It's a good time to be doing a Roth conversions. Those have to be into TD Ameritrade by about mid-December. We have to have that paperwork wrapped up. So if we haven't reached out to you yet, it is coming. We are continually reaching out to a bunch of our clients each week and having those meetings and getting those Roth conversions. Again, not everyone does that make sense for, but a good majority of you it does. And then we'll kind of have year-end wrap-up reviews and have quarterly reviews and then have a good game plan heading into 2023. So, well, I hope everyone has an awesome Halloween. We'll be back on our next podcast here in a few weeks, but gosh, we got Thanksgiving, we're going into the holiday season.
It's going to get busy.
It's going to get crazy.
We got workshops and family events, but I'm excited.
Yep.
Well, thanks, Darrin, for introducing me again. Thanks, guys. Until next time.
Yeah, stay safe, stay healthy, and we look forward to visiting with you again soon. Thanks.
All right.
Bye.
Thank you for listening to the Freedom First Retirement Podcast. Make sure you subscribe so you don't miss any future episodes. For more resources, or if you have any specific financial questions, contact us at abrahamco.com. That's abrahamco.com. The Freedom First Retirement Podcast and related materials are provided for general information and entertainment purposes only and do not constitute accounting, investing, legal, tax, or professional advice. Visitors should not act upon the content or information found here without first seeking appropriate advice from an accountant, financial advisor, lawyer, or other qualified professional.